Good morning, everybody. And it's all about money matters. And I'm here again with Daniel, and you're going to see him a lot more next year because we want to educate you about your money. And he's an expert when it comes to annuities and insurance. And so I asked him come on today because it's towards the end of the year and just kind of to chat about, because as soon as the end of the year is over, we all want to kind of sit down and go through everything we have and see where we need to make changes, because the market's definitely been changing. You don't want to not do things, or you want to look at what you got. So Daniel, go ahead. You're going to talk a little bit about the fixed rate, and then let's talk a little bit about insurance, and you can explain maybe what age should people look at life insurance, and explain the products, because I know they're all changed. So I'll let you take it from here.
Thank you so much. Appreciate it. Thanks for having me back on. It's an honor to be a recurring guest, and hope I can bring a lot of great things for your audience to be able to add value. First off, fixed rates are great. It's the best time in my career. When I started in the business 10 years ago, fixed rates were pretty good. And even at that time, people were thinking they were low, and I was thinking they were low. Well, over the last 10 years, they just went down and down and down. And people, look, if I learned anything from the last decade, it's that people would have just been better off locking in some good fixed rates. So now they're up, and they're higher than I've ever seen them. And so it's incredible what's available now. And so it's a really good time to be evaluating your liquidity, evaluating your fixed account portfolio. So what I mean by that is, like, I'm talking about bank products, like, money in savings, money in money markets, money in CDs, and even money in non-bank products, fixed annuities. Anything that gets a fixed rate, the rates are just much higher now. And it's incredible the kind of rates we're seeing. It's really meaningful interest again, where people can just put money in something that's going to be safe and fixed for a term without a fee, and just get an interest rate declared on the top every single month that they can take as interest income, or they can just let sit and compound. And so a lot of people have been asking me, well, like, what's the difference between taking your interest and compounding it? And so, you can just have let's say you have a fixed account, a fixed annuity that earns 6%. And we have rates as high as that now. And so what that would mean is you could take your interest off the top. If you put in $100,000 and it earns $6,000 a year, you could take $500 a month of interest income. If you wanted to let it compound, well, on $100,000, the first year would earn 6%. The second year, it could earn 6% on the $106,000. So 6% of 106 is more interest. That's the compounding effect. So you have choices and flexibility, but it's just a great time. I'm really excited. We're doing a lot of work, and it's just been really busy helping to serve people who've been waiting for this. Now they can take advantage of all of this inflation and these higher rates and make it so that it's something they can actually use.
Yeah, that's pretty impactful, because I've been looking at the treasuries because they're going up. So let's just use your example. We do 100,000, it's at 6%. What kind of term would that be?
There's different terms. Like, for example, for that range, you're looking at probably like 36 months.
Okay, so the 100,000 is kind of locked up technically, but you'll be able to get the monthly interest or compound it, right?
Yes, there'd be a penalty if you cash it in.
If you cash it in early.
Yeah.
So it would be funds so if you're a senior, you would use it maybe for income. That would have bridged the gap. $500 can make a big difference.
Yeah.
But you definitely don't want to do it if you think you're going to need $100,000 for buying a property or other sources in the next few years, right? But the CDs do the same thing.
Right. Yeah. CDs are going to be committing your money for a term. Now, difference between CDs and fixed annuities: CDs generally have much lower penalties. Fixed annuities can have higher penalties, substantially higher. So that's a big difference to note. But the other big difference is how they're taxed. So CDs, you get a 1099 for your interest every year. Fixed annuities are tax deferred. So you get to compound the money in the annuity and then pay the tax when you take it out. You get to choose. So for higher earners, that might be a more valuable strategy, or for somebody who's close to retirement but isn't quite retired yet and they're still in higher earning years, they could get a deferred interest rate so that they could kind of hold off until they retire. The thought process being, well, maybe their income will be much less, and that might be a better time to have taxable interest, potentially, depending on their tax situation. Their CPA would get involved and kind of give us some instructions on how to do that.
So if after the 3 years, if they don't want to pay tax, can they roll it?
Yeah, they would use something like similar to real estate. They would use something in the insurance world called a 1035 exchange, and they can go
Hmm.
from one annuity product to the other without paying the tax and then just defer it again. So that's
Yeah.
kind of that's a great strategy. But let me speak to your point real quick about the person who might need the money. Liquidity is really important. It's at the core of everything I do. We preach liquidity, and you have to have a good amount of the right liquidity to be able to do anything. I mean,
Mhm.
if you don't have enough money set aside in a checking account to write a check for pretty much anything major, then that being like some type of emergency, something that could come up, some unexpected expense, maybe on average 12 to 24 months of expenses. If you don't have that liquid, it makes it hard to do anything. But if you have a good amount of liquidity already, then it's more appropriate to look at, well, how much excess liquidity are you carrying? Because liquidity comes with a cost. Having a lot of money liquid in a savings account, even though rates are starting to creep up even on savings, it still can cost you to maintain that liquidity. So I would argue that maintaining the right amount of liquidity that's appropriate for what you might need realistically, and then, bucketing the money into like different buckets. This is my liquidity bucket, so I can meet all my needs and my upcoming expenses. And then with this surplus portion, this is money I could bucket for 3 to 5 years to earn a better interest rate. And so that's usually what we try to look for, is what's the appropriate amount to split off, instead of trying to do it all with one bucket of money.
So it might even make sense for people that are leaving companies and going to new, could they roll a old 401k into that?
Yes, 401ks work, IRAs work, Roth IRAs work. You could use it for really any type of account, trust-owned accounts. It's generally more appropriate for people who are age 60 and up, or closer to 60, because an annuity product will have a 10% penalty on your interest if you are accessing that interest prior to age 60. So kind of similar to the rules of almost like a retirement account. So, generally you're kind of looking at, if you're close and you can wait till 60, or you're 60 and up, it's really a great resource for the right person.
Okay. Well, those are great things. And like you said, a lot of people just don't know, and they have their money set. So again, I should put together a checklist, or maybe you even have one we could do on a show of the things you need to do the first of the year when it comes to money,
Yeah, let's talk about those real quick, and we can do it again. But definitely, like I said, any bank product you own, savings accounts, even people keep a lot of money in their checking accounts sometimes, which is actually kind of risky, because if you get hacked, then it could take a while before you get that money back if it's a large sum. Money markets, CDs, any type of just kind of liquid account or fixed account. Even if you have annuities, really where it's great is for people who already own annuities, because if you own a fixed annuity, you could probably get a higher rate right now. If you own an indexed annuity, it's probably pretty unlikely that you're going to get a credit this year. So it could be a good place to, get a portion of money that's earning higher interest. Or, any type of annuity could be available, other than like an immediate annuity or a single premium, like a SPIA. Those ones that are kind of irrevocable, but the ones that you have access to the cash value, it could be appropriate to look at those to try to see if you can get a better rate.
Oh, all kinds of great stuff.
Yeah, all kinds of great stuff to look at.
Insurance, but maybe we'll do the insurance in a second segment.
Definitely.
That way we want to keep everybody back to work. But call Daniel. I'll have all his contact information, schedule a time after the first of the year, and just have him look at everything, because he will put it together for you. And
Definitely.
now, will those rates continue to go up if the Fed continues to raise rates?
Oh man, see, I tricked you. I told you the fixed annuity interview would be small, but you had so many great questions. So this is like the $1 million question right now, and this is so important to wrap up with. We don't know what's going to happen with rates. They're going to be voting. I don't know when this video is going to get out to everybody, but they're voting next week, right? So the 13th. Yeah. So I don't know when everyone's going to see this, but on the 13th they're going to vote again for the last time of the year, and we don't know what's going to be in our immediate future. Are rates going to keep going up, or are they going to go down? So I've been looking at it like this, no one's going to know the top or the bottom ever. Right. You're never going to get it perfect. Right. So just look at your situation and determine what you could live with, right? If you got a fixed annuity or a CD right now and rates went up again, would you be disappointed? Could we possibly implement like a ladder type strategy where we maybe just do a portion now and then see what's going to happen, and then we could, lock in as we go? I have a lot of clients kind of doing that. So it really just depends on your personal needs and objectives. But like I said, I go back to the situation I talked about at the very beginning of the video. if I had known, back in 2012 that it would have been better to just lock people in at 5.5% for 10 years, I would have done a lot more of that. So learning from that last decade, looking at what we have available to us now, eventually, and we don't know when, but they'll bring rates back down and they'll start the process all over where they're printing money and stimulating the economy and quantitative easing. We just don't know when that's going to happen. They got to get inflation under control first. So I'm looking at, hey, can we lock in some great rates now to help protect people for the next decade and try to learn from my first 10 years of my career?
That's a great point. And I have learned, and I've done this job, my job for a long time, but I noticed because the last 2 years were like a gift in the mortgage industry.
Oh, yeah.
I also learned that now that things are changing and property values are kind of changing and some of them are going down, that all my clients that should have done a reverse and couldn't make that.
I know.
And now they didn't lock it in. So you just lock it in when you can, because you can always make changes later, right?
Well, and one thing I feel really good about, Karen, working with you and your company is just, I feel so grateful that you and your team dedicated so much time to me and my clients over the last year, because we were really on a mission to raise awareness. And I mean, we worked hard to try to get as many people in front of you to evaluate their situation as possible. Cause that was, I mean, I think there's still I think it still can really benefit a lot of people right now. But I feel good that we really were proactive during that time. And that's what I'm trying to do again. I'm all about being proactive and trying to make sure that we're not being complacent and helping people, at the best times.
Yeah, because you have to realize when you're speaking with experts like Daniel, they see a bigger picture than you do. And so they've lived through all the ups and downs, so they can tell you, I know now, I should have told you back then to do this, right? Because you can't see forward, and retrospect's a great thing. But anyways, we'll wrap up, but that was a great segment. I didn't know we were so long, but I appreciate all your information. And then we'll do another one on the insurance, because I think we have I can come up with some great questions and see if that's a fit if you don't have insurance to start 2023 off. So
great topic.
Thanks again, Daniel. Have a great week, everybody, and we'll talk to you later.
Thanks so much.
All right, thanks.